Hi, my name is Ritika Abraham, and me, Heidi, Savannah, and Juan are going to go over Chapter 8, the Home and Automobile Decision, with you today. So, just as you work hard to save money, you should also work hard when spending it and take the time to think out and research your buying decisions. There is a four-step smart buying process that I'm going to share with you that you can apply to any purchasing decision. This ensures that your final selection is a product you need at a cost that fits your budget. It places control on your purchasing and eliminates impulse buying. First, I'm going to explain the four steps to smart buying in general, and then my group and I will apply it to an automobile purchase as well as a home purchase. Before even deciding to make a purchase, smart buying requires that you separate your wants from your needs. It doesn't mean that you should never buy anything because you simply want it, but you should recognize a purchase for what it is and make sure you can afford it. Many of the times, these want purchases carry a trade off. It's important to determine before purchasing a want whether the purchase will interfere with your ability to pay for your needs. For example, if you want to buy the new iPhone, this might mean sacrificing other material wants, such as your daily coffee, but you shouldn't need to sacrifice something such as being able to pay your rent. After deciding to make a purchase, it's important to do so wisely. The first thing you need to figure out is how much you can afford to spend. After you determine what your budget will allow, you need to research the details. To do this, do comparison shopping. Most of the time, you can start by your research by looking at Consumer Reports, which is a publication that provides unbiased ratings and recommendations for a host of products and services. There's also Red Laser, which is an app that scans products barcodes and it'll alert you of lower prices online or at nearby stores so you know if you're getting a good deal or not. Lastly, you can look at the Consumer Action Handbook, which is downloadable from the internet, and it's another informative guide on smart buying. And you can also use the internet as a resource. Sometimes it's just a matter of going to the cheapest source and buying the product. However, with some purchases, such as a car, there may be negotiation involved. In this instance, you can increase your chances of getting the best deal possible by first doing all the research you can. One key to negotiating a good price is knowing the markup on the product. In other words, knowing the price the dealer adds on above what he or she paid for the product. Knowing this gives you an idea of how much room there is for negotiation. You also want to make sure that you're dealing with someone who has the authority to lower the price. It's also crucial to consider the various financing alternatives that exist and determine not only which one is the best deal, but which alternative best fits your monthly budget. Smart buying means getting the best product or service at the best price with financing that's right for you. It also means maintaining what you have bought physically, as well as resolving any complaints or issues about the purchase or product. If there is a problem, you can contact the seller. And if that doesn't resolve it, you can contact headquarters of the company that made or sold the product. They usually have a toll-free 800 number that you can find on the product's instruction or on the company's website. You can also write to the company in an email or a letter. And if this problem still isn't resolved, you can work through other local, state, and federal organizations that could provide help. It's important to make sure when you're dealing with the company directly that you keep notes and save copies of all letters to and from. Other than buying a house, buying a vehicle is probably going to be one of your largest investments. 10 years ago, the only decision to be made when purchasing a new car was whether to buy a new one or a used one. Now you can consider leasing. From 2009 to 2020, the number of all new cars that were leased rose from 16% to about 26.2%. What made this new method of vehicle financing so popular? It offers an affordable alternative because the cost of a new vehicle is beyond the means of many Americans. Leasing is renting a vehicle for an extended period with a small or no down payment and low monthly payments. To help understand the process of purchasing or leasing, let's follow the basic smart buying process, adapting it to fit the automobile decision. So, step one, differentiating wants from needs. When you're figuring out which car to buy, you directly pit your needs against your wants. For most people, choosing a car is more than just deciding what best suits their lifestyle and what they can afford. People want a car that reflects who they are. You need to first figure out what features and qualities you need and what features and qualities you just want and make a list of these. The facts of your life will help you determine what are features that you need. Now that you know what features you want and need, you need to figure out how much you can afford. Vehicles are expensive, so you need to figure out what you can realistically afford. It doesn't make sense to purchase a vehicle that will force you to compromise other goals or your lifestyle, so it's important to make sure your purchase fits into your budget. Start by determining the size of the down payment you're willing to make. You can tap into your savings as long as these savings dollars are designated for this purpose. Don't raid savings set aside for retirement or college. Next, you want to determine how much you can pay each month. Automobile loans are installment loans, so there's two ways in which you can determine your monthly payment. The first method is by using a financial calculator, which is using the present value of an annuity calculation to determine payment. The second method is using the installment loan table. Let's look at an example. So let's say you have a 36-month installment loan for $15,000 at 10%, and you want to solve for the monthly payment. You would use 36 as N, and then you would take your yearly interest rate, which is 10%, and convert it to months, so divide it by 12. You would put 15,000 as your present value and 0 as your future value, and then solve for payment. And you would find that your monthly payment will be around $484. You can also use the installment table to figure this out. Now, will you be able to pay this $484, or will you have to change your lifestyle substantially in order to make the payment? If you do need to, you may need to consider a more affordable vehicle or a used vehicle of the same model. A used vehicle can be a reasonable alternative to help match what you want with what you can afford because it costs less and it requires less of a down payment. Savings from buying a used vehicle every 3 years instead of a new one ranges up from approximately $1,500 to $2,000 per year. A used vehicle also tends to decline in value a lot slower than a new one. One downside of purchasing a used vehicle is that it is more likely to have mechanical problems and it may not be under warranty. Now, I'm going to go over making the decision for which vehicle is right for you. You should start by comparison shopping, which means looking at all the choices and trading off the price against product attributes and quality. To do this, use all resources available, the internet, magazines, and visit many auto dealers in person. It is a personal decision at the end of the day, financially and physically, so it's also important to take any vehicle for a test drive before purchasing it. It's also important to consider differences in operating and insurance costs. Used vehicles typically need more repairs and may cost more to operate. Insurance costs can also differ between different cars. Lastly, be sure to address the warranty of a vehicle. The better it is, the lower the future costs. After deciding which vehicle is best for you, you need to make sure you're getting it for a fair price. First, you need to figure out the dealer cost or invoice price. This helps figure out how much the dealer paid for the car, but it is important to know that there is a dealer holdback. This is an amount of money that is typically 2 or 3% of the price of the vehicle that the manufacturer gives the dealer after the sale of the vehicle. This affects the sum of the markup. Additionally, there may be a rebate from the manufacturer or from some other dealer incentives that can affect the actual price you pay. After finding this information, you are ready to approach many different dealers and get quotes on the vehicle you are interested in. This is where you should be ready to negotiate. After rebates, you should not need to pay more than $100 or $500 over the invoice price if it is an American-made car, and a bit more over the invoice for a foreign-built vehicle. What you pay depends on the demand for the car and the size of the holdbacks from the manufacturer to the dealer. Getting quotes is the best way to determine a good price. Negotiating is slightly more complicated for a used car. To find used car prices, you can look on the National Automobile Dealers Association official used car guide. The option of leasing is attractive to people that are financially stable, like to get a new vehicle every few years, drive less than 15,000 miles annually, and would rather not put up with the hassle of trade-in and maintenance. It's also attractive to people that have good credit but don't have the upfront money needed to buy a vehicle. There are two basic types of leases: closed-end leases or walkaway leases. At the end of the lease, you just need to bring the vehicle back in good condition. You have no further responsibility. Many of these also contain a purchase option, which is the option to buy the car at the end of the lease for its residual value or for a fixed price stated in the lease. There's also the open-end lease. This is when at the end of the lease, the current market value of the vehicle is compared to what the value of the vehicle was estimated to be, which is specified in the lease contract. If the vehicle is worth less at the end of the lease, you are required to pay the difference. This difference can be a lot of money and an undesirable option. The key is getting a good lease involves all of these factors listed. You want to negotiate a fair, agreed upon value before signing the lease. Regarding the down payment, it's best to keep this to a minimum. You also want to make sure the warranty covers the entire lease period for all major repairs, and you want to make sure that you define normal wear and tear. You need to know what the termination fee for ending the lease early is and have insurance protection to cover an early termination policy in case of an accident. The lease payment is based on what your vehicle is worth at the end of the lease. You might pay less on a more expensive car that depreciates slowly. And lastly, you want to have the lowest possible rent or finance charge. When you're determining whether to lease or buy a car, you need to make sure that the entire time you're comparing the cost of each over the same time frame. Lastly, step 4, maintain your purchase. It is crucial, given the size of the investment you make in a vehicle, to keep it in the best running order possible. You want to make sure you read the owner's manual and follow its regular maintenance instructions. You also want to set up a car file for all car-related paperwork, such as warranties, insurance information, maintenance records, recalls, repairs, and so on. You want to pay attention for signs of trouble or changes in your car's performance. And a warranty is your first line of protection and provides coverage for basic parts against manufacturer's defects, corrosion coverage, coverage of the engine, transmission, and powertrain. Lastly, you want to know your rights under lemon laws. If a repair shop or dealer can't fix your problem under specific circumstances, lemon laws entitles you to a refund on your purchase. Next, we're going to hear a little bit from Heidi. Thank you.
Hey, I'm Heidi Zern-Kilton, and I'm going to be talking about using smart buying when determining housing. First, you need to choose a housing situation that meets your needs. Houses are a popular choice because they provide space and privacy and greater control over style, decoration, and home improvement. They can also build equity. However, homeownership requires more work because you are responsible for maintenance, repairs, and renovations. Cooperatives, also called co-ops, is an apartment building or group of apartments owned by a corporation in which the residents are the stockholders. Residents have the right to occupy their units as long as they own stock in the co-op. One issue with cooperatives is a bank may be uncomfortable using stock as collateral when getting a mortgage. In addition to purchasing stock, shareholders must pay a monthly homeowner's fee, which goes towards paying taxes and maintenance of the building and the grounds. Alternatively, condominiums are an apartment building or complex that allow individual ownership of the units but joint ownership of the land, common area, and facilities. Similar to a co-op, owners still have to pay maintenance fees that generally cover interest and taxes, groundskeeping, water, and utilities. The difference between condominiums and co-ops is with a condo, you have direct ownership of a specific unit and not just shares in a corporation. Finally, apartments or other rental housing appeal to those interested in affordable, low-maintenance situation with little financial commitment and mobility. Renting comes with limited upkeep and no long-term commitment. A disadvantage of renting is a lack of choice in style, home improvement, and whether you're allowed to have a pet. Using the smart buying method, the first step is to differentiate want from need. You need to determine what is important to you, such as school districts, mobility, or size of physical home. Next, you need to determine your budget and how much you can and are willing to spend on housing costs. The second step is to do your homework. Research how much you can spend on one-time costs. Down payments are the amount of money outside of or not covered by mortgage funds that the home buyer puts down on a home at the time of sale. Closing or settlement costs are expenses associated with finalizing the transfer of ownership of the house. Points or discount points are charges used to raise the effective cost of the mortgage loan, which may be paid in full at the time of closing. Loan origination fee is a fee of generally 1 point or 1% of the loan amount. Its purpose is to compensate the lender the cost of reviewing and finalizing the loan. The loan application fee is a fee generally in the $200 to $300 range that is meant to defer some of the processing costs associated with the loan. An appraisal fee is a fee for an appraisal of the house, which is generally required before a mortgage loan is approved. Although the cost varies depending on the size and location of the house, it can easily run up to $200 to $300. Finally, you have other fees and costs, such as a title search, which is an investigation of the public land records to determine the legal ownership rights to the property or home, and with that comes title insurance that must be purchased to protect you from challenges to the title, such as a forged deed. Next, you need to calculate how much recurring costs you can afford. This would include monthly mortgage payments, which are made up of 4 costs, also referred to as PITI. Those 4 costs include principal, interest, taxes, and insurance. These costs are held for you in a special reserve account called an escrow account. Funds accumulate over time until they are drawn out to pay the property taxes and insurance. Other recurring costs, if you are not buying a home, would be your rent. Finally, you need to calculate your maintenance and operating costs. This would include repairs, updates, and utilities. Just like the smart buying method for buying a vehicle, step 3 is to make your purchase using your budget and making the right decision for you. Finally, step 4 is maintain your purchase using the previously budgeted recurring costs. Now I'm handing it off to Juan.
Hi everyone, I'm Juan and I'll be discussing whether renting or buying is a more appropriate decision for you. We'll begin by looking at some of the advantages to renting. First, mobility. You have the ability to relocate without incurring any real estate selling costs. Second, there's no down payment required. However, you will have to put down a security deposit, which should be returned to you at the end of your lease as long as there's no damages to the property. Third, there's a lower cash outflow just because you're not paying things such as taxes. Fourth, there's no risk associated with falling house prices. Fifth, it includes amenities such as pools and gyms. Sixth, there's no home repair or maintenance expenses. And lastly, there's no property taxes. Now we'll be discussing some of the advantages to buying. First, it builds equity over time. Second, there's the possibility of property appreciation over time. Third, you have the personal freedom to remodel, re-landscape, and redecorate according to your interests. Fourth, there's significant tax advantages if you itemize deductions versus taking the standard deductions. And later on, we'll discuss what those implications are. Fifth, there's no chance of rent rising over time just because you're locked into a mortgage, so you know how much the monthly payment's going to be. And lastly, there's a potential source of cash in the form of home equity loans, which are sort of like a second mortgage. Okay, so now we'll be going over examples of the cost of renting versus buying. So for the renting example, we'll assume that the rent is equal to $900 per month. And for the buying example, we'll assume that $20,000 of down payment is required and the other $80,000 will be acquired through a 30-year mortgage at 8%. The house will appreciate in value at a rate of 3% per year, and the sales commission will be 5%, and closing costs will be $5,000. For both examples, we'll see the difference between renting and buying for 1 year and 7 years, and we'll also assume that the marginal tax rate is 28%. So here's the example for cost of renting. So you'll start with your total rent payments, which is equal to the monthly rent times the number of months, which is calculated there for you. Then you'll take into account the total renter's insurance payments, which is there for you as well. And then the interest lost as a result of making a security deposit, which will be equal to the security deposit times the after-tax interest rate. And it's important to note that this isn't a direct cost, but instead it's an opportunity cost, just because it's saying, had you not tied up your money with that security deposit, you could have been investing it. And so at the bottom, you have the total cost of renting for 1 and 7 years. And we're also not taking into account the time value of money or the fact that once your lease expires to renew, they can increase your rent. So we're just assuming this for simplicity. Next, we have the cost of buying for those who do not minimize. So as you can see, you have your total mortgage payments at the top. Then you have property taxes, homeowners insurance, maintenance, repairs, and utilities, the after-tax cost of interest lost due to down payment. That's another example of an opportunity cost. Then you have your closing costs, which is $5,000, regardless of whether you're in the home for 1 or 7 years. So as you can see, it's better to be in the home for 7 years just because you'll be able to expense those 7,000 over the 7 years as opposed to just 1 year. You'll also have mortgage payments going towards the principals. As we learned at the beginning of a loan payment, you'll be paying mostly interest, and then towards the end, you'll be paying mostly principal. So that's why you can see a big difference between 1 year and 7 years. Then you also have home appreciation less sales commission when sold. So as you know, homes appreciate over time. So if you sell it 1 year after buying it, it's not going to have much time to appreciate. So you're going to be at a loss, as opposed to if you hold it for 7 years, you'll actually see a gain. And then at the bottom, you'll have the cost of buying for those who don't itemize. And next, now we'll go over the cost of buying for those who itemize. So you'll start with the cost of buying a home for those who don't itemize, which we did in the previous slide. And then you'll take away tax savings from the deductibility of interest payments, tax savings from the deductibility of property taxes, and tax savings from the deductibility of points. So as you can see, the cost of buying a home is much less when you decide to itemize. Now, what are the key takeaways? If you plan on relocating, say for work, then you're better off renting because it's going to be much cheaper in the short term. However, if you plan on staying in a place for a while because, say, for example, you like the neighborhood and you're ready to settle down, then you're better off buying a house. More importantly, make sure to itemize because, as you can see, the difference between itemizing and not for 1 year is about 3,000, and for 7 years, it's about 17,000. Now we'll go over determining what you can afford. So there's a couple questions that you have to ask yourself. First, what is the maximum amount that a lender will lend to me? So some of the things that lenders will look at are your financial history, your ability to pay, and the appraised value of the home. Second, should you borrow up to the maximum? So a lender can offer you 150,000. That doesn't necessarily mean you have to take on that 150,000. You can take, say, for example, 100,000. And third, how big a down payment can you afford? So when a lender looks at your financial history, there's certain things they look at. For example, the steadiness of income, the credit report, and the FICO credit score. And it's important to know that if you're a self-employed individual, you may have to provide proof that you've maintained a steady income for several years. And also make sure to check your FICO score and obtain a credit report months before you apply for a loan. Just because if there's an error on there, you want to find that before the lender does, because once the lender takes a look at your financial history, if they see something they don't like, it's going to be very hard for you to obtain a mortgage. Now we'll look at how lenders determine your ability to pay. So in this example, we'll assume an annual gross income of 65,000, estimated monthly real estate taxes and insurance of 200, anticipated interest rate on a mortgage loan of 8%, a 30-year mortgage, current non-mortgage debt payments of 400, funds available for down payment and closing costs of 56,000, closing costs of 10,000, a minimal acceptable down payment of 20%, and a mortgage of 10,000. So this is the first method, which lenders will limit your monthly housing cost to 28% of your gross monthly income, which is the pity ratio. And so you'll start with your monthly income. So we knew that the yearly income was 65,000. So you divide that by 12, that gives you the 5,417 at the top. Then you apply the pity limit, which is 28%. So you take 28% of that 5,417, and then that gives you 1,517, which you subtract estimated monthly real estate taxes and insurance payments of 200, and that gives you your maximum monthly mortgage payment, which is $1,317. And then you're going to want to look at what the payment for that $10,000 mortgage would be. You can use your financial calculator. You would simply put the number of periods to 30, the interest rate to 8%, the future value to 10,000, and that should give you the payment is $73.38. And so to determine what the lender will lend you, you simply grab the maximum monthly mortgage payment of 1,317, divide that by the actual monthly mortgage, which is $73.38, and multiply that by the mortgage, which is $10,000, and that should give you $179,477. Next, we'll look at the second method, where lenders use 36% of your total current monthly fixed payments to determine the amount of your loan. So this is PITI plus fixed monthly payments ratio. And so you'll do the same thing. Start with your monthly income, which is $5,417. You'll apply the PITI limit, which is 36%. So take 36% of the monthly income. That gives you $1,950. And then you're going to want to take away current non-mortgage debt payments of $400 and estimated monthly real estate taxes and insurance payments of $200. And that should give you that the maximum monthly mortgage payment is $1,350. And so we do the same thing, find out what the monthly payment on a $10,000 mortgage would be. It's $73.38 again. So you do the same thing as we did before. You take the maximum monthly mortgage, you divide it by the monthly mortgage payment, and then you multiply by the mortgage. So in this case, it should give you $183,974. And the third method is the 80-20 rule. So most lenders will limit mortgage loans to 80% of the appraised value of the house. And this protects lenders by forcing the borrower to put down a substantial down payment. And so in the event that the borrower does default, the lender assumes possession of the home and they can reduce the asking price by 20% and still recoup their investment just because you already paid 20%. So take, for example, a house that's appraised at $200,000, right? You have to put down a down payment of $40,000. That means that the lender will give you up to $160,000. So what the lenders do is they'll take the minimum of the three methods that we just went over. So in this case, it would be this one, the 80-20 rule, and they'll lend you the $160,000 just because they want to keep conservative while still allowing you to take out a mortgage. So just keep that in mind. And so how much should you borrow? Well, this is something that only you can decide, and keep in mind that you don't have to borrow as much as the lender is willing to lend. So as we mentioned earlier, if they're offering you $150,000, you can take $100,000 as long as you have the other $50,000 available. And take into account your financial plan, your goals, your lifestyle, and your monthly budget, just because you wouldn't want to take out a mortgage so large that it's affecting these four factors. Now I'll pass it on to Savannah.
Thanks, Juan. Hi, my name is Savannah, and I'm going to be talking about how to finance your mortgage, what factors to take into consideration when finding out what mortgage is appropriate for you, and lastly, how to maintain your purchase throughout your mortgage. So first, let's look into the sources of mortgages and mortgage loans. The primary source is through a savings and loan association or a commercial bank, but you can also go through a traditional lender, such as a credit union or a mutual savings bank, or you can go through a specialized lender. These are mortgage bankers and mortgage brokers. A mortgage banker is someone who originates the loan. They will send it to a bank or an insurance company, and they will also service or collect the payments each month. A mortgage broker, on the other hand, is a middleman. They are someone who does the comparison shopping for you and helps you find someone, or helps you find the loan that is the best term and rate for you, and they do that for a nominal fee. So if you want to alleviate some of that stress surrounding finding what loan is appropriate for you, going through a mortgage broker is very advantageous. Next, you want to look into whether it's a conventional or a government-backed mortgage loan. A conventional mortgage loan is a loan from a bank or an S&O that is secured by the property being purchased. This means if you default on your monthly payments, the lender can seize your property and sell it to recover the funds owed. A government-backed mortgage loan is still made through a traditional lender. However, the government insures it rather than the purchaser. This is at typically a lower rate than a conventional mortgage loan. However, there's a lot more paperwork involved to see if you qualify for the loan, and there's a lot of restrictions surrounding the loan itself. But the two primary types of those are a Veterans Administration loan and a Federal Housing Administration. Next, you want to see if this is a fixed rate or an adjustable rate mortgage. So a fixed rate mortgage has a monthly payment and an interest rate that stay fixed throughout the mortgage, regardless of what happens to the interest rates in the marketplace. You're essentially hedging the rate so that you can pay it consistently throughout your loan. These are generally 15 to 30-year terms. However, you can take it out for whatever term you like. but the 30-year fixed rate mortgage loan is the most popular. An adjustable rate mortgage, or an ARM, the interest rate in that fluctuates according to the level of the current market interest rates, meaning your monthly payment will fluctuate as well. This means your monthly payment can rise if interest rates rise, or it can lower if interest rates do lower. Now, how do you know which is right for you? An adjustable rate mortgage does carry more risk than a fixed rate mortgage. The initial rate is lower, however, you're assuming the risk that the rates will rise. In a fixed rate mortgage, those monthly payments are consistent, allowing you to plan in advance and alleviate some financial stress. However, you are at a loss if the market rate's lower since you locked in that rate at the beginning. However, you are at an advantage if the market rates rise because you have locked in that lower rate. And with an ARM, you are obligated to pay whatever the rate is in the marketplace. Some other benefits to consider is the prepayment privilege, which is only available through a fixed rate mortgage. And that's the ability to pay a portion of your payment, your monthly payment, ahead of time each month. You can't do that with an adjustable rate mortgage because you don't know what the monthly payment is because it varies throughout your loan. Another one is assumability. This is the option to transfer your mortgage to another party and that they assume your mortgage obligations. This is beneficial when you don't want to have to incur those closing and reopening costs of a mortgage. And it's nice that you can transfer the obligations to someone else easily. Next, you want to look into the term length of your loan. This is mainly a decision between a 15 or a 30-year term. The advantages of a 15-year term is that there are lower interest rates, it provides discipline to force savings, and your equity grows at a faster pace, meaning that at the end of your term, you may be able to trade up for a more expensive home with your increased credit. With a 30-year term, you have lower monthly payments, which makes it a lot more affordable, especially for new homeowners, and the tax effect here is more favorable with your tax deductions. Now, let's look at the impact of the loan, of the term on the loan, with an example. Here, within a $100,000 fixed rate mortgage at 5%, you can see that for 10 years with a monthly payment of $1,060, your total interest is about $27,000 on a $100,000 loan. Compared to a 30-year term, your monthly payment is about half at $536, but your total interest is $93,000. Now you have to take into consideration the time value of money and inflation that you will be paying for this in future dollars, but that is a little bit daunting and it is a longer term commitment. Now let's make the purchase. First, you have to come up with a down payment. And for first-time homeowners, this typically takes a few years. This is a small percentage of the loan that you have to pay for upfront. Now, you also can pre-qualify for your loan. This kind of lessens the uncertainty surrounding what you can and cannot spend, also making you a more attractive buyer because the seller is able to see that you will be able to pay off your mortgage and pay off whatever you're spending. And then you want to make the purchase of your home through whether it's a real estate agent, an independent broker, or just on your own. Last, you want to maintain your purchase throughout the length of your mortgage. And you want to finance this in the least expensive way possible. You can do so through refinancing, the process of taking out a new mortgage at a lower interest rate in order to pay off a new one. And as a general rule of thumb, you want to do this if interest rates fall 2 or more % than what you're paying. But refinancing is still costly. You have to incur closing costs, such as loan application fees for your new loan, inspection costs, points, etc., and additionally, new opening costs as well. So the question is, will the lower rate compensate for the additional costs incurred in a reasonable amount of time? And now let's look at an example. I have the facts here. On the next slide, I'm going to show the breakdown. So currently you have a 30-year mortgage at 11%, and you're 15 years in, and you're considering refinancing with a new 15-year mortgage, now at 8%. So you initially took out a $100,000 mortgage with a monthly payment of about $950. 15 years in though, you still have to pay off about $84,000 on that $100,000 loan. With refinancing, your monthly payments will drop to about $800. And we're going to estimate that the after-tax closing costs are about $2,600. So now let's see if the drop in the monthly payments will pay off and you'll break even in a reasonable amount of time for this loan. So first, we start with our current monthly payments and we subtract our new monthly payments. So the 952 minus 800 gets you $151.59 in monthly savings pre-tax. You apply the tax rate, and now your monthly savings are about $109 per month. And again, now we say the after-tax closing costs are about $2,600. I divide the two, and I get that it'll take about 24 months or about 2 years to break even on these costs on my 15-year loan. And that's a reasonable amount of time. And taking out this new loan and refinancing would be, this new mortgage and refinancing would be advantageous and beneficial to you. We hope that this makes you more comfortable with your smart buying decisions. And on behalf of my whole group, thank you for watching, and we will now take any questions.